Homework problem 1, this is labeled exercise 3.2 in your text. They ask us to do a bunch of things for two different kinds of companies. The first is a service industry, Hopkins CPA, and the second is a sports clothing industry called Sports Clothing, cleverly enough. So, they give us these pieces of information, and then for each entity, they want us to prepare an income statement, a balance sheet, and a statement of cash flows, cash in, cash out. They want us to look at which of the two companies would have product costs. We want to talk about why the accounting firm does not compute gross margin, and what, looking at the assets, which do they have in common and which do they have differently. So, let's get started. We'll do Hopkins CPA first. Hopkins borrowed $90,000 from the bank. Well, that's not revenue, that's a liability. So there's the income statement. And it's kind of unorthodox, but we're going to do them at the same time because there's not a whole lot. So the liabilities go on the income statement, $90,000. Remember, revenue and expense goes on the income statement. The balance of the accounts go on the balance sheet. So this is not revenue or expense. It's a liability. It goes on the income statement. The next thing they tell us is that they provided $60,000 of services. We make sure you got that piece. Provided $60,000 of services. Sold. That's what that means. That's the key word there. Sold. So, $60,000 of services, collected $50,000 in cash. So think about what they did. They got $60,000 worth of revenue. That's what they earned. So they earned 60, got 50 in cash. And what's the other 10? What do we call money that we will receive? That's accounts receivable. So we got cash for $10,000. That's an asset. And accounts receivable, $10,000. That's also an asset. So let's come over here to our balance sheet. We got $50,000 in cash. Okay. And we borrowed $90,000 from the bank. So potentially right now we have $140,000, but we're not quite done for the month. So let's see what we have to finish up here. And then they paid salary expenses. And again, I want you to see the key word, paid. Cash went out the door, paid. So they spent $32,000 for expense. Expense goes on an income statement. So we have the expense. So our net income for the period, revenue minus expense, $28,000. And remember, that's going to float to retained earnings. That's where that goes. Remember the funnel we talked about. So now let's take a look over here at our cash. So we had plus 50, plus 90. Okay, so we got 50 here, and 90, that's 140, minus the 32. So that gives us $108,000 in cash. And remember this $10,000 in accounts receivable? That's also an asset. So our total assets are $118,000. Our total liabilities are $90 because we're told that we had nothing else. And remember from the income statement that $28,000 net income goes to retained earnings. It goes through the funnel. So let's put that over here. Retained earnings, $28,000. Now we need to do our basic balance sheet addition. Our liabilities and our equities have to equal our total liability and equities, and that has to equal our assets, and it does. So we've got that in good order. Now the next thing it asks us to do is statement of cash flows, and everybody freaks when they think statement of cash flows. It's not that tough. It just sounds like it is. It sounds way more complicated than it is. If I saw you on the street and said, hey, how much money do you have in your pocket? If you answered that question, you just did a statement of cash flows. So let's do a statement of cash flows. Going back to this, they received $50,000 in cash from customers. Cash inflow from clients, $50,000. That's an operating activity. Remember, operating activities are what we get for doing what we do. Then we had cash outflow for salaries of $32,000. Those miserable employees insisted on getting paid. So our net cash flows from operating activities, $18,000. Cash flows from investing activities, they didn't tell us anything about it. And if they don't tell us, there were none. That would be a 0. Now, cash flows from financing activities. Remember, financing activity, when we sell our stock, we sell our bonds, we sell or borrow money from the bank on a note, we take a mortgage. And we did have one of those because they tell us that we went to the bank and borrowed 90 grand to start our business. Now, having started a CPA business, I have no idea why you need 90,000, but they said they did. We'll believe them for no other reason than they said. So that's cash coming in from the bank, 90,000. Now, our net increase in cash, those two. Notice it doesn't say how much cash we still have. It just says the net increase in cash total. So that's 108,000. This is our first year in business, so we had a beginning balance of 0. And even if you went to Philadelphia Public Schools, you can add that. So that's the financial statements for a service industry. I'm hoping at this point you looked at it and you say, well, that was actually easier than I thought, because that's what I want you to have. Now, let's do the sportswear industry. So we'll start with their income statement. And we'll bring over their balance sheet as we need it. Now, this is an industry that buys and sells stuff. So they're going to have a little different set of financials. So first of all, let's go through and look at their balance sheet and their income statement like we did with the other one. for the sake of consistency. And on their balance sheet, they also borrowed $90,000 to start the business. So potentially, they have $90,000 in cash. But we know that's not going to stay that way. And I'm a big believer in doing stuff and checking it off. We purchased $60,000 worth of inventory. So we purchased inventory for $60,000. Now, did we have all that inventory? Hopefully, no. I mean, hopefully we sold some. But let's write down our $60,000 for now. Okay, they sold inventory that cost $26,000. So our inventory that cost $26,000, we sold for $50,000 in cash. So potentially that's $50,000 more in the cash account. Then they paid $8,000 for operating expenses. Paid, magic word, paid $8,000 out. So, all together, take a look at our totals and let's make some sense out of all of this. We need to do an income statement first. Oh, by the way, I'm a moron. I said plus cash. We bought $50,000 worth of stuff, and I said we got $50,000 more in cash. I happen to be a moron. Sorry. Oh, no, wait. It was sold for $50,000 in cash. I'm still a moron. I'm just a confused moron. So let's take a look at our total and see if we can make some sense out of this. Our sales revenue, that was the $50,000 that confused me and then unconfused me, then confused me again. $50,000. Our cost of goods sold, again, they told us that, $26,000. Our cost of goods sold, $26,000. Here's a new account for you. It's a new definition. Revenue minus cost of goods sold gives you gross margin, also called gross profit. And in this case, it's $24,000. And now our operating expenses were $8,000. So our net income is a total of $16,000. And again, remember, like before, that's going to go directly to the bank. That's our, the bank, directly to retained earnings. Okay, let's take a look at this and see what's going on here. We have to figure out the balance in our cash account. The balance in our cash account is a total of, let me see if I can find my notes here, because I don't remember. Yes, stand by. I know I got my notes here somewhere. The balance in my cash account is 90. Let me work out the whole cash account for you so you can see. We started with the 90 that we borrowed. Then there was $60,000 for the merchandise that we bought. That took us down to 30. Then we sold merchandise for 50. That took us up to 80. And then we paid our operating expenses of 8. So our cash was 72,000. That's how much is left in the cash account. What we borrowed minus the inventory plus the sales minus the operating expenses. So, balance in the cash account, as per the other side of the paper, 72,000. Now, how much inventory do we have left? If we had 50 and we sold 26, so our beginning inventory was 60. I'm sorry, I said 50. Our beginning inventory was 60 minus what we sold was worth 26. We have $34,000 left. Beginning inventory was 60. We sold 26. We have 34 left. This is a different computation than this. This is what we sold and what it cost us to buy. This is what we had altogether and what it cost us to buy. So our inventory is a total of 34. So our total assets at this point are $106,000. At this point, I'm hoping that you remember that this and this, our total assets, have to equal our total liabilities and total equities. Let's see if they do. So our total liabilities, again, with this company, it's the same. It's just the $90,000 that we borrowed. And our net income of 16, which goes to retained earnings. Remember the funnel. This magically goes over to here. Retained earnings, 16,000. Add the total liabilities and the total equities. We come up with $106,000. Now, the last thing they ask us to do is a statement of cash flows. And again, this sounds more daunting than it is. Let's take a look. Cash inflows from customers. They told us that we collected $50,000 from customers. Cash out for inventory. Told us we spent $60,000. Told us that we spent $8,000 for operating expenses. Now, you're all saying, whoa, you can't collect 50 and spend 68. Like hell you can't. Happens all the time. So our cash flows from operating activities are minus $18,000. Yep, this month it cost us $18,000 to stay in business. We borrowed $90,000 from the bank. And at the end of the year, our net increase in cash was really a decrease in cash. We had 90. We borrowed 90. We spent 18 at 72,000. First year in business, 0, so we had no cash to begin with. Our ending cash balance, 72,000. That's a company that sells things. The new part there is the fact that you have to account for the merchandise. That's an asset. And when you're doing the income statement, you have to do a little side computation called cost of goods sold. Now, it says which of the two companies would have product costs? Clearly, only the sports business. A service business doesn't sell product, they sell service, so they wouldn't have product costs. Why does Hopkins not compute gross margin? We talked about that. You may not have picked up on it because I went over it a little quick. Gross margin is revenue minus cost of goods sold. CPA firm has revenue, but they don't sell anything, they sell services. So you can't compute gross margin if you don't sell product. And the assets of both companies, what do they have in common? They have in common cash. What they don't have in common is merchandise inventory. Bit of a long problem, harder to explain than do.